Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. So glad to have you tuning into this episode. You're listening to number 398. The title is Investment Portfolio Construction with Dr. Craig Israelsen. Before we get the day started, I always like to get started by renewing our mind. And this verse comes to us from Mark chapter 10, verses 29 and 30. Truly I tell you, Jesus replied, no one who has left home or brothers or sisters or mother or father or children or fields for me and the gospel will fail to receive 100 times as much in this present age. Homes, brothers, sisters, mothers, children, and fields, along with persecutions, and in the age to come, eternal life. I heard somebody speaking recently, and they were talking about the promise for abundant life now and then eternity in heaven. And he said it like this. He said, being a Christian is not just pie in the sky when you die, but it's steak on the plate while you wait. Anyways, here's a joke to share with the grandkids. Why was the math book so sad? Because it had too many problems. In today's podcast, I interview Dr. Craig Israelsen. We talk about banking turmoil, portfolio construction, asset allocation, taking a pension versus a lump sum, how much guaranteed income is needed in retirement, when to start Social Security, diversification across asset classes, when does active management make sense, should you have exposure to China, and near the end of the show, we had a more philosophical discussion about what it means to live a good life and the contribution that we make. Let me tell you a little bit more about Dr. Israelsen. Craig Israelsen, PhD, is an executive in residence in the financial planning program at Utah Valley University in Orem, Utah. Primary among his research interests is the analysis of mutual funds and the design of investment portfolios. He's written for Barron's Magazine. He was a writer for Financial Planning Magazine for over 20 years, and he's a regular contributor to both Horse's Mouth and ETF.com. His research has also been published in the Journal of Financial Planning, the Journal of Asset Management, UK, Journal of Performance Measurement, Asia Financial Planning Journal, Singapore, Journal of Family and Economic Issues, and Financial Counseling and Planning. His research has been cited in the Christian Science Monitor, Wall Street Journal, Newsweek, Forbes, Smart Money Magazine, Kiplinger, Retirement Report, Advisor Perspectives, Dow Jones Market Watch, Family Circle Magazine, and Bottom Line Personal. Dr. Israelsen is the developer of the 712 portfolio and the author of 4 books. His most recent books include 712, A Diversified Investment Portfolio with a Plan, and Start Investing Now. It is my good fortune to be able to bring Dr. Israelsen back onto the program to share some of his wisdom and insight with you. And without any further ado, I hope you enjoy this discussion with Dr. Craig Israelsen. Dr. Israelsen, welcome back to Sound Retirement Radio.
Thank you very much.
It's great to have you. I'm really looking forward to this conversation. I know the first interview that you and I did together was very well received. And today I've got a bunch of questions I want to ask you. And I thought we could start off the conversation just because all of the headlines right now are about the banking industry and some of the concerns that people have about the stability of banking in the United States. So share with us your thoughts about banking. Is this a time to panic? Should people be pulling their money out of banks? What are your thoughts?
Well, usually with any sort of upset in any sort of industry, you might think of it like the insurance industry. If an insurance company gets in trouble, there's a lot of other insurance companies that understand that public confidence is goal number one. And insurance is particularly affected by public confidence, and banks are kind of in that same situation where public confidence is critical to their success. So obviously the federal government obviously has an interest there as well to calm things down. So all I'm saying is that there's a lot of parties that have a vested interest to solve whatever situation is arising. And it doesn't mean that bad things can't happen. They just kind of tend to happen in the short run. Mm-hmm. And in the long run, things solve. In the process, there are situations where people may suffer a loss not likely the case here with this banking situation. Maybe I tend to be, I don't know that I'm overly optimistic, but I'm certainly not a pessimist.
Yeah, yeah. The problems problems to be solved, and smart people that we will solve them as a people.
Yeah, yeah. I mean, that's our history.
Yeah.
So
why would we think it would be anything different than solving problems? Yeah.
Right.
Yeah.
It is sad that there's when banks get leveraged in ways they can't resolve quickly, and there is a bit of a bank run, which was the case at Silicon Valley Bank. There's a classic example of the public confidence sort of it's yelling fire in a theater. That's just really a bad idea. And that kind of happened in this case.
But I wonder how much of this response to what happened with SVB or Signature Bank is a memory of what people went through in 2008 in the financial crisis. And so they're bringing back all of that. They haven't dealt with everything that happened prior. And they're like, I don't want this to happen again. And I have to tell you, we even see instances where people are saying, get all of my money out of the stock market because I'm worried about what's happening. And we don't want to go through another financial crisis. What do you think about that kind of response to this current headline?
Well, if what you just described, if the response is, I'm going to pull all my money out of equities and fixed income and the whole deal, that's a response that's completely disproportionate to what's happening here, because the primary difference is that in 08, 09, 2010, you had the technical term is tranches. You had just massive tranches of really, really cruddy loans. Cruddy meaning that they were loans that should not have been made. And so you had a lot of failures of loans. That the case here largely is, it's not that that's not the germinal or the seminal core issue here at all. You had some banks that were in a position that they couldn't cover positions quick enough based on a bank run, and so it's kind of fascinating. In 2023, we can see a bank run. You kind of thought that was over,
right,
100 years ago. But it illustrates how important it is that we don't act in a panicked way. As investors, as depositors, we really do affect the institutions that we participate in, and this is really a vivid example of that. Now, I think SVB was, I'm not sure, I don't know the percentage of their deposits that were individuals. My impression is it was more of a startup, a high-tech startup bank.
Sure.
So when we talk about deposits being withdrawn, we're talking about companies pulling out pretty big chunks of money. And most of us, anybody listening to this podcast, is probably not the same kind of client that SVB had.
Right. That's true.
I'm just an individual, and so I've got money at a credit union, and there's just no correlation between my little credit union in Utah and what's happening, at Silicon Valley Bank. So, anyway.
A couple of thoughts I had, and I'll just kind of rapid fire these at you and give you a chance to respond. I saw an article recently. Elon Musk said, "Look, just insure all of deposits because we should be living in a day and an age where people shouldn't have to worry about their money going away at banks." So that was one headline I saw, and I can understand his point there, but I can also understand where we could really create an environment where there's a lot of bad behavior if banks know that there's no consequences for what they're doing. So that's one thing. The second thing is, in some ways, we require banks to have a certain amount of deposits on hand. Banks like SVB are buying treasuries, which they assume are safe. The Federal Reserve ratchets up interest rates rapidly. Then the SVB has this run on deposits. So then now they have to sell these bonds at a discount. And it's almost as if the Fed created this whole mess by, creating a system where they say you have to have these deposits on hand, and then we're going to ratchet up rates, and now you can't cover them because you have to sell them at a big discount. So there's that issue. And then the other thing was, you just mentioned credit unions. Well, we never hear about credit unions causing these big financial meltdowns, and credit unions are member-owned, they're nonprofit. Would the entire banking system just work better if everybody ditched the banks completely and we all just went to credit unions? So kind of bunch of different things on your plate there, but what are your thoughts?
Yeah. Well, I agree with the idea that if every deposit was insured, I mean, now it's what, $250,000? Is that right?
250,000. Yeah.
Yeah. So for individual investors, you and me and people listening to this podcast, the current system is just perfectly adequate. Yeah. Removing consequences in any form, in any aspect of a person's life, of societal life, of corporate life, that's just a really, really bad idea to remove consequences. And so it's almost like it almost feels like we just live in a day and age where, we can't have that pain. Can't have that pain, and FEMA comes in and takes care of everything, even though people didn't buy flood insurance. And the examples are just kind of proliferate. And the prudent, the people listening to this are already people that are pretty prudent.
Yeah.
And for that reason, I've spent a lot less time listening to national news over the last probably 2 years. And I guess I would suggest that as, if you're going to take action, let's put it this way, Jason, if you're going to take action, consume less news.
Yeah, boy, I love that. I'm like you. I have gone on a severe diet of social media and news, other than business news, stuff that I need to be aware of.
Correct. Yep. Because planes that crash make the news, and we know that. We know that planes that crash make the news. And yet, we feel like there's some sort of due diligence. Well, I have an obligation to know what's going on. Oh, you know what? If it's really, really germane and it really reflects reality, you'll know.
So what are your thoughts about everybody just going to a credit union, no longer having these big multinational banks anymore?
Kind of a theoretical question, because I don't think we'll ever go there.
Yeah.
My grandpa was involved in the start of a credit union up in Logan, Utah, and we've always kind of been fond of them because of his involvement. But, well-run local banks, well-run regional banks, they're just part of an important financial structure. So I have no problem with the different, we have S&Ls and we have banks and we have credit unions. It's kind of like operating systems, for different computers, that it's fine that they coexist. It's just, it seems to be that when there are issues, like you pointed out, the issues tend to be with banks that got too leveraged, with S&Ls that got too leveraged in housing bubbles like in Texas in the 80s. And credit unions largely kind of aren't in those stories. And so I don't think that that's a broad brush implication of banks and S&Ls. I think it is a reminder that when you're trying to meet the demands of, quarterly reports and expectations of stockholders, that a poorly run bank that gets out over their skis too much in terms of risk to try to keep shareholders happy, that sadly is kind of a toxic mix sometimes. But again, most banks won't fail, and those that do, it's a reminder yet again, thinking short run, not thinking long run.
Yeah. Well, so what is your thought about this comment? Because we've actually seen this happen where people are so fearful of what's happening right now, and the financial crisis is so front and center in their memory bank of what happened, the last time we went through a severe financial meltdown, that they're taking everything out of equities and moving everything to cash. And you said a minute ago that's not a good response to the current situation. Is there ever a time that you can think of that would justify that type of behavior? Sell everything and go to cash?
Yeah, it would be pretty extreme. it's kind of like theoretical. Something that's not theoretical is you have a known event that's going to cost you a pretty easily defined amount of money, such as a child going to an expensive university, for example. So there you have a hopefully 4, maybe 5 year expense. You know it's coming. It's on the calendar. You might begin to move some of that money that's going to be used to pay for their college costs to a more stable environment, such as cash. That's not based in fear. That's based on the calendar.
Yeah.
It's not unlike a target date mutual fund.
Mm-hmm.
And so you're just responding to a known outflow of money. I think as a general guideline, when there's a large move in, now we're talking about portfolios, when there's a large move that was not anticipated at the formation of the portfolio, and it's based in fear, that's generally not the right setup. That's not the right conditions. Fear becomes really, really something we need to work through. That's obviously the value of an advisor. It's kind of like an advisor is to a person's wealth management akin to a medical second opinion. And it behooves us, we learn from experience, to get a second opinion on important medical procedures. And to move in a well thought out portfolio, suddenly to move it to cash is analogous to wealth management surgery. And the question is it elective? Is it elective surgery? You don't just casually do elective surgery on a portfolio.
That's really good. I like that. Framework. I want to ask you, I know we're going to get into investing, and this is where you spend a lot of time with portfolio construction and asset allocation and retirement withdrawals, and you've built spreadsheets on RMDs and what this looks like. And I'm looking forward. I know our listeners want to get into that, but I wanted to run a couple of questions by you that we've seen come up frequently recently, and that is, we see people that have the opportunity to retire early, and one of the things that many times they're faced with is, do they take a pension from their employer or do they take the lump sum? What are your thoughts on that decision, and what are ways that people should be thinking about the best way to make that decision?
Well, it's kind of like buying insurance. A pension has some sort of an insurance annuity element to it. You're really banking on the financial viability of the provider of that pension, or in the world of insurance, the provider, the insurance company that's underwriting that annuity. In other words, if you're getting the pension from XYZ Corp, is XYZ Corp going to be around? I mean, that's the bet you're making. And if you have any iffiness about that, then that's kind of the answer to the question in my world. If you're a little bit uncomfortable with the viability of the company providing the pension, take the payout, and then invest the money with. There's any number of Vanguard, Fidelity, Schwab. I mean, these are companies that manage trillions of dollars. And obviously an annuity, a pension, and I think a pension and annuities is kind of very similar, that pension is formulaic. And so if a person might believe that they could do better with a chunk of money and produce a larger cash flow. And I don't doubt that. But I think that individual would probably, if you're going to equate taking a payout and building your own pension, if you're going to equate that with taking a pension, then you probably need another teammate in that process, because the institutions that are creating that, and the people and the teams and the overseers that are creating that pension, that's more than one person. So now you take on all those responsibilities if you take the payout. So that's where I would say, wow, you need to get a financial advisor that works with you on this and becomes that second opinion, becomes that stabilizing element. Is to take that on yourself now. I mean, that's kind of like a risk transfer.
Yeah.
And you have no experience. Let's say the payout is $800,000 or whatever it might be. How much experience do you have managing $800,000?
That's a great question. Yeah.
If you don't, then get some help, and that help's going to cost you. Great.
Yeah.
What it's going to cost you is likely going to be a fraction of what you could cost yourself if, in that process of managing that money, we make some emotionally charged decisions that turn out badly.
Yeah. And I just want to clarify, as you use the term annuity and we talk about pension, we're talking about an immediate annuity, a guaranteed income stream from an insurance company, usually for a lifetime, sometimes with a spouse included. They can be period certain, but we're talking about income annuities because there's so many different types of annuities out there that could really open up a whole different conversation. But for today's conversation, we're talking about this immediate annuity, a guaranteed income stream. And I know that there's a lot of people in the academic community that are fans of mortality credits and fans of this idea of creating some guaranteed cash flow beyond Social Security. In your mind, as you talk to people about retirement, and you think about their essential expenses, not the discretionary stuff, not the travel and paying for Netflix or whatever, but the essential stuff, is there a certain percentage of somebody's income that you think would be wise to have coming in on a guaranteed basis using like a pension income or an annuity income?
Well, I think a lot of people view Social Security, kind of in that light, and I don't think that's incorrect. I mean, I think the Social Security question is, will you have exactly the payout that was promised to you 10 years ago? No, probably not. There's going to be fractional decreases over time, but the idea is that you're creating a cash flow that covers, like you just said, essentials. I know that Moshe Milevsky, he's pretty high on that, and some of the academics, and Moshe is the one I can think of that has kind of reversed his position on that over the years. And it may be because
how did he reverse his position when you say what?
Well, academics have tended to be kind of critics of annuities, just I think because of the cost, and it might be 250 basis points, for example, and they just think, well, you can just do it yourself for less. Well, that's kind of a nice idea on a chalkboard. But so I think Vanguard was in the annuities business for a while, decided to get out, which is kind of interesting. But if the cost is reasonable, you look at the popularity of annuities after 2008, boy, the interest spiked. That's very revealing.
Well,
and so
yeah, like I say, you can open up this whole can of worm with annuities and the different types of annuities that exist out there. But just to keep this to, again, our listeners, just keeping it to the income annuities specifically. What about let's say your essential expenses, you need $80,000 a year just to be able to live a base life, pay electric, garbage, water, sewer, dining out, putting food on the table. Let's just say that number's $80,000. And let's say in Social Security, you're going to have $40,000 a year of Social Security coming in. Do you think that's enough guaranteed income to meet your essential expenses? Do you think having a replacement rate of 50% of your essential expenses is high enough? Or do you think people should consider having a higher amount of guaranteed income?
Well, 50%, that's that's a good question. That's a tricky question. If a person has a reasonable portfolio, a retirement portfolio, a 401k and IRA balances, in all likelihood, it's really, really difficult to deplete those if you are reasonable in your withdrawals. Even RMDs, RMDs don't deplete a portfolio within 25 years. And so in a 4% withdrawal rate, basically a 4% withdrawal rate, that portfolio, your retirement portfolio, is going to grow over time if you're only pulling out 4%. But that implies you have at least a 50% equity position in your portfolio. And so,
And how often do you go to cash with that 50% equity portfolio?
You don't.
It's such an important
Exactly
concept.
right.
This is
That's to the point.
yes.
You have to be brave. If you're going to be brave, if you're going to be brave, guess what? You got to be brave.
Hmm.
And so if you have basically a 50-50 portfolio, 50 equities, 50 fixed income and cash, then you got to stay with that as a retiree. And if you do, then I would be comfortable with a scenario where you have a 50% replacement income ratio with fixed sources, a pension or a social security, because your portfolio is going to take care of the rest. If you're not comfortable going to at least 50% equity, in other words, your retirement portfolio is maybe only 20% equity, then that's the lever that would then motivate you to get more coverage of your fixed expenses from an immediate annuity and those type of income replacements. It really hinges in my in the analysis that I do. It really hinges on what you are willing to do as a retiree in your asset allocation in that portfolio. And 50 to 60% equity as a retiree becomes kind of a pivot point.
Okay. So I want to ask you about equity and asset allocation here in just a minute and get into that because I know you spend so much time there, but I just wanted your thoughts on Social Security. Started at 62, 67, or 70. There's benefits of delaying. Have you given much thought to kind of rule of thumb? If you were talking to a large audience, what would the recommendation be?
Yeah, it gets tricky because if you have a spouse that also is a qualified worker, that really changes the scenario. So if I retire at my normal retirement age, what's referred to as the NRA, and my spouse retires at her NRA, then if my benefit is larger than my spouse's, and it doesn't matter what gender we're talking about, we're just talking about two spouses, one of them has a higher benefit, and it may be materially higher. As soon as if I have a higher benefit, as soon as I retire, it moves my spouse's to half of mine. Whoa, that means I'm motivated to retire or to start taking benefits maybe before I turn 70. Because if I wait till I'm 70, my benefits go up. But if I take my benefits sooner, and if I've reached my NRA, it moves the spousal benefits up to half of mine. And so that's a tricky equation that my wife and I have actually been looking through and calculating. I built a spreadsheet,
Spreadsheets were all the great things in life happen.
And
my wife teases me.
So in our situation, it makes sense for my wife to take her benefits at her NRA, which is 66 and 8 months. And then for me to take mine, and she's 2 years older than I am. And then I receive my benefits as soon as I hit my NRA. That makes the most sense in our situation.
Okay.
But every situation is going to have its little nuances. If you're talking about a single earner who has a lot of investment income and they enjoy working, and they're going to work easily till they're 69 or 70. Yeah, I mean, there's not a strong argument to take benefits as soon as you can. The argument would be just put them off till you're 70 because you already have income. And so as a general guideline for a household that has one qualified worker or a single individual who is their own, they are the only one, probably in a lot of circumstances, the general advice to wait till you're 70 probably makes sense. But then there's all those caveats. You have plenty of income until you're 70. So
yeah,
it's really been an educational experience for my wife and I, because I always, again, as an academic, the general advice is, don't take it early, let it, ramp up and wait till you're 70. Well, that general advice doesn't really consider the spousal benefit that jumps to half of the larger wage earner. In fact, it really just kind of ignores that, and that has to be considered.
I want to ask you, let's switch gears and talk about where you spend so much of your time researching and studying, and that has to do with portfolio construction. You know, you're heading into retirement. This is not a time in life where you can say, okay, I'm going to start figuring this out. How am I going to manage my portfolio? It's like you don't want to be guessing as you're making one of the most important financial decisions of your life. And like you said, most people don't really have any experience managing, whether it's a lump sum from a pension or even their 401k, because oftentimes that's been managed in some capacity for them as well. But now all of a sudden it matters. And we were just a minute ago, you were talking about how much to have allocated towards equity. I was talking to somebody recently and they said they were really questioning this idea of a 60% stock, 40% bond portfolio because of what happened in 2022, where that type of strategy could have been down 15, 17, 20%. And so give us your thoughts about portfolio construction coming out of a year like 2022, where bonds didn't give you that buffer, that ballast like they have in the past.
Yeah, 2022 is that's a weird deal because you had bonds that the aggregate bond index was down about 13%. When's the last time that happened? Never. Not since 1926, at least in the database. A lot of our data for analysis starts in 1926. And so the previous worst bond year was basically in minus 3% back in 94. So you go from a -3, which the previous worst for bonds, to a -13. So there's nothing wrong with, my opinion, there's nothing wrong with a 60-40 as long as the 60-40 is far more diversified than just large U.S. stock as the 60% and U.S. bonds solely as the 40%.
Tell us why do you say that?
Well, the recipe, that's fascinating because the 60-40 model has been around since the 30s, the 1930s. And, since when is 60-40 balanced? I mean, the first irony is in the actual title and then the mathematics of it, and it's really, it's kind of funny to stand in front of an auditorium and tell a bunch of students, the balanced fund is 60-40 and kind of waiting for some little kid to raise their hand and say, well, I kind of thought 50-50 was balanced, but, I'm from a small town. Maybe and so the 60, you have they're not equally weighted. So the lean into the higher allocation to equities is because over time, equities simply produce a higher return. And a retiree, when you start retirement, let's say at 70, you could easily have 2.5 decades in retirement. You're still a long-term investor in that sense. And so when you have an asset class like equities that is known to have a higher return over longer time frames, then you tend to weight that a little heavier. Now, so that's the logic behind a 60-40 and it not being 50-50. Let me say it this way. As a young worker, so a person who's still accumulating retirement assets and taking trips with their kids and living life, allocating hopefully, 10 to 12% of their income to their retirement nest egg. If they don't want to be super diversified, that's fine. I mean, I think diversification is always a sound principle. But if you divide your life into 2 time frames, pre-retirement and post-retirement, and you ask me which of those 2 times is more important to be more diversified, I will always answer in retirement. Mm-hmm. That's the time to be more diversified if you had to pick. Now, the thing is, you don't have to pick. You don't have to bifurcate your life that way. But in the accumulation phase, a person might easily be 80% stocks or 80% what I'll call portfolio engines. And an engine would be stocks. It would be real estate mutual funds, commodity mutual funds, natural resource mutual funds, just a whole bunch of things that produce equity-like returns and that have equity-like volatility. And then you have the other side of the camp, which is bonds, government bonds, corporate bonds, municipal bonds, But then the one aspect of bonds that a lot of people leave uncovered is non-U.S. bonds. We're not the only country in the world that has bonds. And so, I would say for a person who wants to diversify, at the very least, if it seems intuitive to diversify in your engines from U.S. stocks over to non-U.S. stocks and small company stocks and medium, mid-cap stocks, if that makes sense, that same sense should prevail on the bond side, and to diversify into a variety of bond exposures, to include non-U.S. bonds. And if we get into sort of the active managed funds, mutual funds that are actively managed versus funds that are passively managed, which are kind of generally called index funds, there is some value to think about. Okay, where would active management, if I was going to if I was going to commit to some portion of my portfolio that's active, where might that make sense? Well, one of those areas might be fixed income bonds, because of what happened in 2022. Does it mean that an actively managed bond fund didn't have a loss in 2022? No, it doesn't mean that. It just means that you're with an index, the manager of an index, whether it's a stock fund index or a bond fund index, they don't have any flexibility. The index. So if you're invested in the S&P 500 through SPY, for example, probably the largest ETF on the planet, the manager of SPY, they can't do anything if the market starts to tank. They have a commitment to stay 100% or 99.8% allocated to the 500 stocks in the S&P 500 index. An actively managed stock fund, that manager is given some prerogatives in situations like '08, where they can diversify out into other asset classes, or they can move to cash too, to a certain extent, within the mandate of their fund. And so an active manager or the addition of actively managed funds in a portfolio isn't an all or nothing. A person might have a commitment to, generally speaking, an index-based kind of passive type of approach to investing. That's great.
Yeah.
I totally get it. I support it. I build models that look like that.
Yeah.
But then they might have some different aspects. They might have their international small cap aspect actively managed. They might pick an actively managed fund. They might have another bond fund that's actively managed. In other words, when we talk about diversification, we're talking about making salsa. And we're just starting to throw stuff in this thing. We're putting in tomatoes, cilantro, onions, and then we throw in some cucumbers. Why not? And then some corn. Let's throw some corn in. And the idea is that salsa, there's a lot of stuff that you can add to salsa, and it makes it kind of fun, makes it interesting. And portfolios aren't a lot different, because when you're in retirement and you have a year like 2022, boy, you want to look across a really diversified portfolio and say, whoa, wow, 4 or 5 of these or 6 or 7 of these funds didn't do so well, but I've got a couple of other little sort of weird duck, kind of zebra funds over here that did okay. Well, that's where the money comes out of that year. See, that's the whole point of diversification as a retiree, that you have enough differences among all the funds and ETFs that you own that 1 or 2 of them hopefully did okay in any given year.
You mentioned fixed income might be one area that people would want to consider active management. What would be another area of a portfolio where you mentioned small cap international. Is there any other areas that come to mind where you would say, hey, let's consider having an active component here?
Yeah, small cap value. So small cap value in the U.S. So small companies, and these are companies that I don't know how technical we ought to get here, but the price to earnings ratio of those stocks tends to be a little more in line with reality, and
they're on sale even in some instances.
They're a bit on sale. I don't know if Maytag qualifies as a small company. They probably do, but a company like Maytag, wow. Maytag, how exciting is that as a company? Oh, it's not. That's the whole point.
Mm.
You know, but they just make good appliances, and so small cap value tends to be an area that it's an interesting area of mutual funds because a lot of them close.
Yeah, because
Mutual funds, they won't receive new money because well, there's a lot of reasons why, but suffice it to say that if you find a good small cap value fund, stay in it, because you might not be able to get in it down the road. And many of those are actively managed. So it doesn't mean that, like, the S&P has the small cap 600 index. Well, it's actually a pretty good index, and mutual funds that excuse me, track the S&P 600, small cap 600, they do well.
Tell me about your thoughts on emerging markets. China is considered an emerging market, which to me seems really kind of funny that we are still calling China emerging market with the size of their economy and what they're doing. But right. China is acting pretty aggressively towards the United States these days. They've assigned a war council. Does it make sense to continue to have emerging market exposure when China tends to be a large portion of emerging markets, given their posturing towards the United States? Now, I know before this conversation, you and I both talked about not wanting to go down any political routes. So this is certainly not intended to be a political conversation, but just more of a, we saw this happen with Russia. Russia attacks Ukraine, and some companies got out of investing in Russia, some did not. When is the time to say, hey, this is not something I want to be exposed to, regardless of the benefits of diversification? What are your thoughts about that?
Yeah, that's a tricky question. There are funds. I mean, you can really target your exposure of where you invest. So there are funds that exclude certain countries. I'm sure China's one of them. I haven't done a search of those funds that specifically exclude China, but I'm quite certain that they exist. If we exclude, I would put it this way: if you want to exclude China in your investment portfolio, first go for about 60 days trying to exclude China from anything you purchase. And you're going to find that is really tricky. That is really hard. They know that the U.S. consumes a lot of stuff, and they have no problem producing that stuff. They're 6 times the size of us, or 5 times the size of us? I mean, they're a big country, and maybe I gave the wrong ratio, but they're a lot bigger than us, and they have a lot of people to put to work, and they do good work. There are a lot of things that are made there they're wonderful. But the question is, politically, are they an adversary or are they an ally? Well, right now they're acting more adversarial. And it kind of comes back to what we started talking about, banking. Are we going to fix that with China? And I hope we do. I have nothing against the Chinese people, and neither do you. But right now we're sort of like two kids on the playground, kind of threatening each other and acting like, punks. Both of us are. And so I hope we solve it, because if we're going to be a consumption society, which apparently we are, well, we need China.
Do we continue to have
they need us.
Do we continue to have our portfolios allocated to China at this phase of the tension?
Well, it's going to be tough. I mean, if you pull out, a lot of international funds, they mirror, or they approximate the Morgan Stanley EFA index, which is Europe, Asia, and the Far East. But generally, that EFA index doesn't have a heavy exposure to China. In fact, technically, it's not supposed to be in that index. Technically,
right.
And so what's called the EM, or the Emerging Markets Index, which would be a base index that some emerging market funds would mirror or track, that's where you're going to get the China exposure. Or you can go, there's any number of ETFs that go straight at China. That's the only thing you invest in. Well, I think your question is probably more germane to those ETFs that just isolate and solely commit to a Chinese economy investment. Yeah, that seems a little bit daring right now, probably going to resolve over time. But a more broad-based exposure to emerging markets, I think, just in general makes sense. And I don't think that anything happening with China right now changes that general perspective on I want to invest in developed non-U.S. countries and emerging. I mean, South Korea is still technically considered an emerging market, and it's just like, what does it take?
Right. That's
to
what I'm
live?
saying. Yeah, they got this label, and it's going to be on them forever. They're emerging.
Yeah, I mean, if South Korea is not a major economy, good grief. I mean, uh, they're kind of like Japan was 20 years ago, just really the young tiger. And but Japan is still considered a developed economy, which it is, but they've had a lot of banking problems over the years. And so, yeah, I mean, South Korea, wow. I mean, I you look around, I mean, who's not driving a Kia or a Hyundai? And so, yeah, I don't know that it's a great time necessarily to go into a mutual fund that targets China specifically. But I don't think it's a time to pull out of an emerging market exposure because, again, we have to think about these investments that we're making in terms of 10 to 15 year periods. And the news today is going to resolve itself within usually 6 to 12 months, and something else will replace it. We'll always have something replacing the news today.
Yeah.
And so there's always going to be a rationale to bail out on something.
That's right.
And that's where I think I do want to say this at some point. The most important asset class in a portfolio is patience.
Why do you say that?
And that's not something you can get from Fidelity. You can't get it from Vanguard. You can't get it from anybody other than yourself. And if you have an advisor, that combination of people, that's who brings the patience to the portfolio. And it really is. The mark of a seasoned investor is their willingness to separate wisely noise from news. And frankly, I don't know. I could make up some percentage on the spot here, as to how much of the news is noise. And I won't pretend to make up a number, but it's a really high percentage.
Right. It really is. Well, I wanted to ask you, a minute ago, you talked about having more than just two simple asset classes, S&P 500, large cap stock exposure, and U.S. Treasury bonds. And you said that you would want to have more diversification than that. What's the right amount of diversification to have in a portfolio heading into retirement? How many different asset classes do you need to have exposure to?
Oh, I would say at least 7 or 8. The model that I built has 12 different tickers. It's called the 712 model, but there's nothing magic about it. There's nothing magic about 7 silos of asset classes, 12 tickers. That's just what was reasonable to me. But, something over 7 or 8, and we're not. The problem is that unknowingly, I think a lot of people end up with their 401k account and they have 7 or 8 funds, but unfortunately 5 of those all mimic the S&P 500.
Right.
But they have different names. And then so I thought they were different because they have different kinds of names. I mean, one says Tiger, and so when we're talking about different asset classes, we're talking about they're not in the same category. And so you'd have a fund that mimics the S&P 500, okay, that's a separate category. But then you have another fund that mimics medium-sized companies in the U.S. Okay, that's a different category. People call that mid-cap. Then you have a small cap. Then you have non-U.S. funds. Then you have a real estate fund. Real estate has been a wonderful asset class over the last 50 years, underappreciated. This is commercial real estate mutual funds. Then you have commodities, and commodities, they were just horrible for a number of years, and then just have been carrying the banner the last couple of years. That's because commodity funds thrive when there's inflation. They are the cause of inflation, if you want to think of it that way. Commodities, when oil price goes up, that's a big kicker in inflation. And so some aspect or some exposure to something commodity like is a good long-term play. And maybe it's, and people, when I say commodities, they think of gold. No, gold would be a separate singular exposure. Commodities is grains and energy, oil and livestock. And so it's a broad basket commodities fund that we're talking about here. And then your fixed income. You want some, like we talked earlier, some diversification there, a U.S. bond fund and a non-U.S. bond fund and a cash fund, or at least cash on your own in a savings account. And so it's very easy with the asset classes I've just enumerated.
Yeah.
You're easily up to 8 or 9 right there.
So let's say somebody has 8 or 9 asset classes they've picked to be well diversified. How much do they weight to each asset class? How would you guide them on weighting towards these different asset classes?
Well, this is where it's helpful to think in terms of the salsa. Is it a mild salsa? Is it a medium salsa? Is it a hot salsa? A hot salsa is where you have, say, 80% or more in the engines. And engines would be anything that's stock related, anything that's real estate, commodities, natural resources. Those are all engine type of funds. And that's a big, big camp. In that camp, you have lots of different tents, different types of specific asset classes. And then your portfolio breaks, would be your bond funds. And then, of course, the irony is that last year, those brakes were on fire. The brakes didn't really behave like brakes.
But do you think it's better, though, now that interest rates have gone up so much and they've reset it? It almost feels like 2023 is a better year to retire than 2022, at least from a protection standpoint. You can actually get a little bit of yield on money markets and savings accounts and short-term bonds and intermediate bonds, and everything's looking better on the bond side. It seems like it's going to provide more downside protection going forward than it did last year.
Yeah, I mean, as you drive around and look at the marquees of banks, what they're advertising, you don't have to walk very far to get 5%, and sometimes you don't even have to commit it for a year. I've seen. I thought I saw 5% for 6 months. Wow. If I can get guaranteed 5% and a 6-month commitment or a 10-month commitment, good grief. That's great. I-bonds, I-bonds through the government. They were up at over 7 or 8% last year. They're probably a little lower now, but that's another way to diversify. You can't put more than $10,000 a year per person, but still it's an interesting little sleeve, they could easily add to a portfolio. So as interest rates go up, the traditional bond exposure becomes a little bit less attractive, and cash becomes increasingly attractive. I mean, my students think of cash. When I say cash, they think I've lost my mind, as a portfolio asset class, because their experience over the last 6 years is that cash pays basically nothing. And now relatively suddenly, it does. Well, the long-term return of cash for T-bills, 90-day T-bills, is just under 5% per year. That's the long-term number. And so we have been since 2008, cash went to about 1.4% return for the year, T-bills. And then since then, it was, 16 basis points, 15 basis points. I mean, just barely above zero. And that's the world my students have lived in. And that's a lot of the world that a lot of us today, we're still kind of stuck in a kind of a zero interest rate. If we're putting money in a savings account or a CD, we're getting nothing. Well, that was the anomaly, honestly, historically speaking. We're now returning to normalcy in terms of what a CD would offer. And so I would encourage people, if they're going to be more conservative by choice in a portfolio, great. But be conservative in that, say, 40 to 50% component. And if you want to go away from a bond mutual fund and into traditional cash, fine. There's nothing wrong with that. But we want to have brakes and engines. We always want to have brakes and engines on this go-kart.
I'm teaching my teenage daughter, how to drive right now, and sometimes I wish I had a second pair of brakes in the car.
that's the thing. I mean, would we take the brakes off the go-kart so we could go a little faster and then put our grandchild in that? How do we explain that to our daughter whose child is my grandchild? Well, I took the brakes off because I thought Dave could go faster, a little bit less weight. I mean, that's just lunacy. And so as people modify when the brakes outperform the engines, then we think, oh, I should have had more of this, more bonds, more cash. And then the engines outperform the brakes, which is roughly 2/3 of the time. If you think about a portfolio broadly, 2/3 of the time your engines outperform the brakes. So that means 1/3 of the time the brakes outperform the engines. Well, don't try to time all that. Always maintain a commitment to brakes and engines. And for a retiree to build, let's say, a 50-50 portfolio, 50% engines, 50% brakes, that is a perfectly acceptable portfolio. It will get the job done. If you take out the RMD, you will not run out of money before you're 95 or 100. You just won't. If you pull out 4%, if the RMD doesn't apply, you won't run out of money. It's when we mess around with the portfolio and go into speculative garbage. When we over withdraw it, that's what kills a portfolio. Crappy investments. Sorry, probably shouldn't say crappy on the radio. So cruddy investments, over withdrawing, that's what kills a portfolio. Well thought out portfolios that have broad exposure to a variety of asset classes, keeping costs under control, portfolio, try to keep the expense ratio, at 60 to 70 basis points or lower. Withdrawing prudently, you just can't kill the portfolio. I know that sounds like I'm trying to sell some snake oil. I have studied and studied and studied. I have looked for periods of time where a 4% withdrawal rate would kill a portfolio. I just can't find it, historically speaking, using actual index performance numbers. And so the key is, though, you got to have at least 50% equity, and you got to stay with it. Yeah. You can't bail out.
So you write a lot, you teach, you speak. Is there one topic when you're speaking with your students or teaching your students, or you're speaking at one of these conferences, or you're writing for like the AAII, is there one topic where the light bulb comes on for people and they're like, oh, now I get it. That seems so obvious. Do you find that there's a moment with your students where that light bulb comes on?
That's a great question. I think one of the light bulbs that I think I have observed coming on is when diversification is really described. And so what I'll usually use the salsa metaphor. I may use kind of a go-kart metaphor here, but salsa is my favorite because I love salsa. So a person becomes familiar with investing, and they're just starting their learning curve, and they discover these mutual funds or ETFs that have 500 different stocks in them. It's an S&P 500 clone fund, SPY, VOO, whatever it might be, VFINX. And they think, whoa, that is awesome. I didn't know these things existed. Boy, that's convenient. And I'm diversified. I got 500 stocks, man. And if I've already taught the salsa metaphor, I will say, you have 500 tomatoes. Oh, I see what you're saying. That's that light, that they have diversification, but in that context, they have 500 large U.S. companies. Well, what about 500 large companies outside the U.S.? Are they going to behave differently? Yeah, you could say, well, recently they seem to be tracking each other. There's a lot of truth to that. But then there'll be years where they don't. And that's what we're banking on in broad diversification, is that these things behave somewhat differently. And so I think it's the understanding of what we really mean when we say diversification. Having one fund that has 500 stocks in it is a starting point of a portfolio. You have diversification among U.S. large companies. meaning you have diversification among tomatoes.
Mm-hmm.
You have Better Boy and beefsteak and Roma. Okay, but they're all going to grind up and be red. And so you need to add some non-tomatoes to that. And that's where we get into these other asset classes we've been talking about. That to me is probably one of the biggest light, turn-ons, is to really begin to appreciate that diversification is across asset classes and not just within an asset class.
What everybody really wants to know at this point, is it medium, mild, or hot salsa that you like?
Well, you know what? As I get older, I'm a little bit more inclined to the medium.
Okay. All right.
Yeah. Which is kind of sad, kind of embarrassed to admit that on national radio here. But
So this has been a fun conversation. I want to talk to you for a minute about non-financial stuff, because it's I think it's where people spend most of their time as they're preparing for retirement, because it gives them a sense of control. But the reality is many of us have built our lives around our careers, and now people are making this transition into a new phase of life. You get the money thing squared away, you're going to be okay. How do you live a good life?
I'm going to embarrass you. I say you look at Jason Parker.
No, you don't say that.
Yeah, you do. There's a dude who's doing it right. And I just, you and I have talked off the air, and you talk about your daughter a lot. You're focused on, I don't remember if you have more than one child, but you focus on that next generation. The most important things aren't things. So I think you're a spiritually sensitive guy, and I think you're aware that there's a lot of things that we have in our lives that represent a stewardship and represent a focal point of our efforts, and that our resources allow us to bring that focus to those areas, whether it's a ministry among, a kindergarten teacher. A kindergarten teacher has his or her ministry, to bless the lives of those little children. My career has been in the university auditoriums teaching big classes of personal finance, and that was one of my ministries. But then I was involved in the Boy Scouts, a Boy Scout, Scoutmaster, and then we have kids and grandkids, and the resources become the enabling element to facilitate a lot of those activities, and many of them it doesn't take money to do a lot of this, but then it does take some money to do other aspects. So I think if our financial stewardship isn't enhancing our other stewardships, we're probably doing our financial stewardship incorrectly. Let me say it another way. Money is a magnifier. Money magnifies virtues and vices. And I think, sadly, if we look around at the national news, if we take a peek, often we can see examples of both. But I would say, sadly, I think I see examples of where money may have distracted people. I'll be kind, and they're distracted from what their stewardship might have been.
Mm.
So, money. If we just bear in mind that money magnifies us, it's a reminder that how is it magnifying us? Is it magnifying and growing my virtues or my vices? And if we look in the mirror and say, you know what, I've got some improvement to make. Great, there's the first step. And here's one idea. Here's one idea that we can all do. We can check our portfolio less often. That's an idea. In fact, I heard a mutual fund manager, Ron Mullenkamp. You may remember the Mullenkamp Fund.
Mm-hmm.
So Ron was at a meeting I was at, and he said, you know what, folks, if you want to take volatility out of your portfolio, why don't you just check it less often?
Mm-hmm.
I thought, of all the meetings and conferences I've been to, which are a lot, that's probably the best thing I ever heard.
I like that. These things that you can't get from Fidelity or Vanguard. It's not what you, and it's patience, and it's opening your statements less and taking the volatility out of the portfolio.
Yeah.
What when it's all said and done and you're looking back over your time, how do you hope that, because you do so much research on this portfolio construction. People can find more at the 712portfolio.com, the number 712portfolio.com. You put so much effort and study and energy into helping. Really what I think you're doing is you're giving people confidence to know that if they do things a certain way, they're going to be okay. But what do you hope is the lasting legacy? What do people remember about you when it's all said and done?
Well, I'm glad you said what you just said, because the research that I've been doing the last 5 or 6 years, which is on retirement portfolios more specifically, has given me a lot more confidence that I shouldn't live in fear.
Mm.
Living in fear is a cruddy way to live anyway.
Yeah.
But in terms of a portfolio, if I'm reasonable, if I'm prudent, I won't kill it. I won't kill the portfolio. So there's no reason to live in fear about that. But at a personal level, if I think about, say, the interaction I had with my students over the years, probably one of my favorite student comments, and this I think this was at BYU. It may have been at Missouri or BYU. I can't remember. But the student said, I didn't really like this class. This is a personal finance class. I didn't really like this class, but I knew that Dr. I cared about us. And so I decided to kind of take it seriously. That really touched my heart, because I do care about these kids. I've got kids. We have 7 children, and a lot of my students are very dear to me. And I've had 16,000. I actually added up all the spreadsheets one time. I have no life, Jason.
You got spreadsheets for everything.
What kind of life do I have?
I have to have you over for dinner sometime so you can tell my wife about all these spreadsheets, because she's always making fun of me and my spreadsheets. So you make me look good.
Oh, it's crazy. Anyway, I've had a lot of students, and I still have interaction with students. And I hope that they know that I cared about them, because I believe God cares about them. And I'm trying to be more like God. I'm trying to be more like Him. So I think there's kind of a trite, people don't care how much you know until they know how much you care. I know that sounds like some sort of sappy birthday card, but I've just, in my line of work with students, and then I know a lot of financial advisors, guys like Jason Parker. We're just trying, hopefully we're just trying to be good to each other. And if we'll just start there, just try to be good to each other and be compassionate toward each other and try to be helpful and not always look for what's in it for me. Again, I'm going to embarrass you. You're trying to help people, and you have a company to run, and you have a business, but ultimately, I just kind of think, no matter what you did, let's say you designed bridges, you'd probably do what you're doing right now on the side. You feel like you're being helpful.
Oh, I know it. I know we're helping thousands of people, not just through the podcast and having guests like you on, but through the calculator. Yeah, it's that, to me, that's exciting. Let me ask you a question, and this is really personal, and you don't have to answer it if you don't feel comfortable. But you said you said God a moment ago, and in society and culture today, that can really make people angry to talk about God, especially when we're talking about a finance show. Has God always been a part of your DNA, or did you find a relationship with God at some point, or how did that change over time?
Well, I was raised in a very religious home, and I had a student one time at Missouri when I taught there ask me, "So, are you a religious guy?" And I said to him, I try. It's an everyday deal, isn't it? We're trying to be spiritual. We're trying to be sensitive to our spirit, to the spirit of others. We're trying to be more like our heavenly parents and to be good children in every sense of the word. So, yeah, I have no problem talking about God as my maker and Christ as my example. And they're my role models. And if other people feel differently, I perfectly respect that. We were just over in Morocco visiting a daughter who's living there. And that's a Muslim nation, and they're beautiful people, and they have some beautiful beliefs that they're trying to be true to. And I respect their genuine efforts to be true to their beliefs. And because of that, they're gracious and beautiful people, and we loved interacting with them. So I think to the extent that we recognize that we're on this globe for a season, and in that season we have work to do. And a lot of that work is to refine ourselves, to become more refined and more aware.
Do you find that culture's changing at all in the classroom when you bring up a subject like God or your faith or your belief?
Well, I had a student again at Missouri, and Missouri is a state university. Of course, BYU is an LDS university, and so at BYU I could be more open in my conversations, about spiritual things and religious things. At Missouri, I had to be a little bit more careful, but I would read from the New Testament. For example, at Missouri, the parable of the prodigal son in Luke 15. And I had a student come up after and say, "Why did you do that?" And I said, so I thought the parable fit the topic today quite well. He said, "Oh, no. Why did you use the King James Version?" Oh, I see. That's the one I have. Oh, okay, thanks, bye. And I was sort of, backpedaling a little bit,
Interesting.
And his question had nothing to do with whether it's germane or not, or why I did that in a public setting. But what I would tell my students at Missouri is that, listen, I understand this is state university, and that there's a bit of a line between church and state, but I know of no such line between state and spirituality. Let's pull out your wallet and look at a dollar bill. In who do we have trust? In God we have trust. It's right there on our money. And if it's going to be on our money and we can't talk about it in public, then maybe we shouldn't use our money in public.
Interesting.
That's what I would say.
I like that. Well, Dr. Israelsen, I enjoy our time together so much, and I appreciate you do so much to teach, and I just appreciate everything that you're putting out into the world and how you're trying to help people, and I thank you for that. I enjoy the conversations when we get to talk about hiking mountains and some of these other topics besides finance, but if you ever do make it out to Washington State, the invitation is open. I'd love to go for a hike with you sometime. So thanks for being a guest on the show today.
You're very welcome. Thanks, Jason.
All right. Take care.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.